Hey everyone, welcome back to Mitchell Markets. Today we are talking about an extremely important topic, and that is implied volatility. Have you noticed options are very expensive lately? You're right on direction, but you're still losing money and overpaying for contracts that were a third of the price a few weeks ago. And none of that is random. It all just comes down to implied volatility. The CBOE Volatility Index measures the market's expectation for volatility over the next 30 days based on the S&P 500 options. It's not direction, it doesn't tell you up or down, but it tells you how large the market expects the moves to be. Higher VIX means higher volatility expected, and lower VIX means lower volatility expected. And as you can see, I currently have the CBOE Volatility Index up for the S&P 500, where you can see massive peaks and valleys. Over the course of the last month, a low of 1330 and all the way up to a high around 35, which is a drastic range over the course of a month, influencing options pricing. Here's a clean and basic overlay of the VIX and the S&P 500. As you can see, the larger spikes in VIX are inadvertently showing downward trends in valleys in the S&P 500. And you can see this throughout the time. So what is implied volatility? Implied volatility, or IV, is the market's expectation of how much a stock will move in a given period of time. The important key here is that IV is directly embedded into the option pricing. If you look at this option chain that I have pulled up, IV is directly tied to the cost of option. So a higher VIX is directly signaling a higher asking price for the same options. So why is a high VIX equaling expensive options? When VIX rises, implied volatility also rises across the entire market. That means calls cost more, puts cost more, and all premium increases. And the reason for that is larger expected moves cause the probability for options finishing in the money to increase, resorting for more risk as a seller and more opportunity as a buyer. As you can see on the chart here, when implied volatility is low, calls are cheaper. Implied volatility rises, calls, puts, just premium in general has more value. When you buy options in high IV, your break even is going to be farther away on an equal cost basis. So you're going to need a larger move to profit. So if you were to pay $5 for a contract, again, if watching prior videos based on 100 shares would be $500 total, you would need at least a $5 move roughly to break even. And a lot of times in high IV, the premium is actually slightly inflated. And as you can see on this graph, based on the premium you're paying, you will be farther out of the money on a cost basis. The same contract that would be at the money could be double its original cost just weeks ago. Now, the most important part of all this is called IV crush, and this is where most traders are going to be getting destroyed in a high VIX environment. Even if the stock does move in your direction, if implied volatility drops at the same time, it can cancel out all of your gains and then some, even turning wins into losses. And that exactly is IV crush. A lot of times this happens after large events such as CPI, earnings, Fed decisions, or when certainty gets removed, just like our current environment. One day a war is imminent and the following day the war is apparently ending. That IV crush is extremely unpredictable and volatile and can ruin option positions. Before the event, think of it as a high IV, and after the event, the implied volatility can drastically reduce, killing your contracts. In this example that I have on screen, we have probability density and underlying price at expiration. Blue is 15% IV, which is signaling the price at expiration is predicted with highest probability to be within 80 to 120, which is far more predictable than a high IV environment at 45%, where it's almost evenly distributed across the board, signaling very large gains or very large losses. Now let's look into one possible way to capitalize on high IV environments, and that is selling options. High IV can actually benefit sellers with, of course, some additional risk because you're collecting a higher premium, time decay works in your favor, and if IV drops, the option prices fall. But as I mentioned, there is more risk associated with this, and that is that the market is expecting larger moves, and those moves can work against you quickly if wrong before IV crush even happens. So there's again more premium up front, but also more risk. So if volatility is high, don't chase moves. Enter near key levels, be it support or resistance. It's good to take profits faster because as quickly as you had that gain, you may also lose it. Understand your actual break-even point, not the premiums included in the contract. And be precise if you're buying or selling before large events. So if you're not understanding implied volatility and points to be weary on, as well as be able to capitalize on opportunity, then you're not actually trading the option. You're just betting on direction. Thank you guys for tuning in to Mitchell Markets, and be sure to remember implied volatility before looking into any option contracts, selling contracts, and always keep one eye on the VIX. That does it with today's episode of Smart Money on the Volatility Index.